Hello, I'm Lyndon Wood, and at the request of my audience, I'm making another video on developing wealth. Just for the record, I'm not selling anything. I'm not sponsored by anybody. I just feel I have an obligation to share what I've become to understand. And if that helps one person, two people, 100,000 or a million people, fantastic. Um, I just enjoy doing these things. I'm not sure if YouTube put adverts on the video. I don't care. It might bother you, but it just doesn't worry me. I'm not earning money from it, which sort of contradicts the investment strategy, I guess. But just the way I prefer it. Uh, Look, we're in an economic climate that is very challenging from an investment perspective. I'm going to share my sort of strategies and what I've become to understand from the vast amount of research, the years of investing, and actually more recently, different things I've discovered. So look, we're in a moment of having to crisis invest because there's a lot of uncertainty in the stock market or equities. That's the sort of stock price you might buy Tesla and CRISPR and these sort of things. Incidentally, this is not advice, by the way. It's just my experience and my strategy. Uh, you have to invest your own time into your own things and realize that it's a mindset shift from the way you've lived your life to where you really need to be right now. You can either operate on the fixed income you have and have that limitation, and whether that is 15, 20, 30, 40, doesn't matter if it's £100,000 a year salary, it's your maximum income. Or you can shift your mindset and consider a new way of living your life and a new way of managing your money to develop wealth. And wealth is very different to cash. You may have a job now. You might not have a job in the future. You just do not know. So anything that you have spare, it doesn't matter if it's £20 a month, £10 a month, or £3,000 a month. You should always consider an investment strategy to sit alongside your fixed income. Now, look, it's like crude oil. Crude oil is worthless until you do something with it. Now, if you consider your cash, that's like crude oil. It's not worth a lot. In fact, if you leave it in the bank, it goes backwards because of inflation. And we'll come on to inflation a little bit later on. The greater the inflation, the less your money is worth. And what goes along with inflation are usually interest rate increases. But I'll do a screen share in a minute and share that with you. Now, my videos are not polished. I really don't edit them. I quite frankly, I haven't got the patience. So they're very raw and real, which is the way I prefer it. We're in an artificial sense of prosperity. And that means with the printing of money from the Fed and the UK government, etc., it can make the stock market appear to be doing really well and give us that good feel factor when investing. Whereas in fact, we are in a bubble. And I'm sure there are many, well, I know there are many expert opinions that will support that. We are now about developing wealth for the next generation. So for our kids or our grandkids, our nieces and nephews, because they are in a generation, as you probably experience, of renters, of not really buying things. They're not really super keen on buying cars. They actually invest in cryptocurrency, but they tend not to hold a job down, or they tend to do 3, 4 different things at the same time. So we have to, and of course, the houses are too expensive for them to buy and get on that ladder for the housing market. So we have to invest and consider the next generation. Now, of course, you have to look at your own life as well, because you have a right to live and you have a right to live comfortably and to have the nice things that life has to offer and the experiences it has to offer. So you have to invest with both strategies, and it's what I do. So my investment strategy tends to consider the next 6 months, the next 2 or 3 years, 5 years, and then 10 years. And I divide everything I do up into those sort of segments so that every part of my life, there's either a windfall, or I'm able to take some cash as a consequence of my investments. Now, keeping on top of all of this can be quite daunting. But look, I mean, I'm not an expert. I listen to some key experts on YouTube. I do some Googling, and I make an informed decision, as you should with any serious decision in your life. So look, the connection between inflation and interest rates. I'm just gonna grab a screen share. Let me just, I've got my wrong glasses on here. It makes me sound really old. Here we go. Let's do that. And let's share that. Now, hopefully you can see this Word document here. There we go. So look, this is what happens during recession. Now, in the US, it tends to, they drop interest rates by up to 5% in order to stimulate the economy. The UK tend to do about 3%. So if you go down since the Great Depression, 1929, interest rates drop from 6 to 2. And as you can see, we'll go down the chart there, 7 to 4, 6 to 4, 8 to 5, 17 to 9, 15 to 6, 5.5 to 0.5. You remember 2008, that was the big banking crisis. 2020, 4% down to 0.10. Inflation, I couldn't find the 1929 inflation figure, but if you look at inflation, inflation increases in line with interest rate drops, or it's actually vice versa. Inflation goes up, then they have to stimulate the markets. So you've got 1.49, 4.2, 10, 18, 2.3, 3.5, 0.85, and then 1.5. Now, the UK, I believe, is already at 3% inflation. And the States, on my last look, which was about a week or so ago, was at 6% inflation. Now, the problem you have is that they can't drop interest rates any further because they're already at an all-time low. And what that means is they just need to print more cash, which you can see in the media, that's exactly what they do. Now, of course, that has to stop at some stage. And when it does stop, then the whole markets just go absolute bonkers and, you know, it just gets a bit crazy. So I'm going to close that down. Just give me some background there. And we're going to screen share again because I've got important things to show you. Here we go. Now, if you look at investments, property's always been a good investment. I have always invested in property over the many years and built up a property portfolio, which has served well. As property prices increase, you're able to remortgage. That money becomes tax-free. And then, of course, you can use that capital to invest either in your business or into other things. You know, I buy gold, I buy silver, I vote that. I invest in some businesses. I do buy equities like Tesla and CRISPR and some other things, Neo and so on. But I also invest in quite heavily into various cryptocurrencies. You know, whether that is Bitcoin, XRP, Ethereum. I tend to give a little bit of a spread so that I'm protected for every eventuality. And the last 12 months has been a real eye-opener for me because historically I would just do equities. But since 12, 13 months ago, I thought at squeaky bum time, and I thought I need to spread my investments because I wasn't sure how the market was going to go. So I embarked on buying physical gold, physical silver, and I put that in a vault. Bitcoin, Ethereum, XRP. So I invest in crypto, and of course, business. You know, my own business. So I get that good, healthy spread. So that in any eventuality, if the equity market declines, then I would hope that gold and silver goes up. When inflation goes up, I would hope that they would revalue gold and possibly silver, and my gold would climb. And of course, crypto being, some of it being decentralized, which means the government do not control it, sort of stand on its own. And with the trends that you see, when the equity market drops, as in the stock market, I've spotted a trend where crypto tends to climb a bit. Now, right now, as of today, and as of the last couple of weeks, it's sort of everything seems a bit stagnant. It took a drop, So did the equity market, and it's stagnant. Now, we have to understand that markets are manipulated. So you get what we call whales, which are not the animal in the sea, which are huge institutions or individual investors buying up hundreds of millions, sometimes billions of pounds worth of stock, or crypto, etc. And then when they want to manipulate the market, in other words, drive it down, they'll sell a load, and then they'll buy a load again when it's cheap. And they manipulate the market that way. But that's the way it's always been. It's nothing new. So let's go through the screen. So as you can see, house prices here, as you can see, 180,000, going back 2008, the big crash. And then, of course, it climbs right back up. So you can see from a housing point of view, over time, it always climbs. So I treat the acquisition of property as a long-term investment. It's not a quick win. I hear everybody wants to get on the property market. They want to be a landlord and this, that, the other. Lots of regulation when it comes to being a landlord these days. It costs. So property is a long-term gain. It's a long-term strategy. And when I say long-term, I'm talking minimum 5 years, probably 10, maybe 15. That's how I view the properties. So let's have a look at what I've got next. I think we've gone into inflation here. All of this information is freely available. It just takes you a little bit of time to research. So there's the inflation charts. As you can see, it's where I got my information from for that Word document. What do we have here? Interest rates. Now this is a particularly interesting one. So we can go back here as a 1 year. You can see, look at the trend. Look at it. 2010, we got year 2000, then we go the big banking crisis. As you can see, it drops, and here we are floating along really low. You can see that, and of course you've got lots of other data there. And I've got this button is completely in my way. Let me just move this a minute. Here we go. Historical interest rates. Now, interestingly, this is where I bought my first property back in about 1990 something. And my mortgage interest rate, and it's hard to believe, was at 15%. So can you imagine paying 15% interest on your mortgage? But I did, as did many others. And in fact, some others paid 18%. They went really high. But you can see back then, right up there, 16, 17, 18%. And you can see we're right the way down here. So you can see what's happening. So you can actually match this up against recessions and as far back as 1929, so that you can see patterns and trends, just like human behavior, as in government, as in the stock market, crypto market, housing market, interest, inflation. There are always patterns and trends. You just spot them and sort of draw them out. That helps predict the future a little bit. Nothing's guaranteed, but it helps. And you see UK inflation rates. I'll skip over that because we have talked about that. The gold standard. Now, I think it was about 1970 when the gold standard ended. That is where the dollar was linked to gold based on gold valuation. That ended in 1971, so it stood on its own. Now, who knows? The dollar may get linked back to gold. I'm not sure. I'm not convinced it will. Am I convinced that gold will climb? Absolutely. I keep buying gold at every opportunity. Am I convinced that Bitcoin will climb? Absolutely. It's more like a digital decentralized gold, in my opinion. Will the dollar link to Bitcoin? Who knows? Will it link back to gold? Who knows? Will it be gold, Bitcoin, and the dollar? Who knows? Anything can happen. We're in a crisis investment stage. I tend to buy my gold and silver from the Royal Mint, and I vault it with the Royal Mint as well. Very easy to do if you're interested. If you buy Britannia coins in the UK, any profit is actually tax-free. So keep that in mind, because that's a big benefit. Tax-free Britannia coins, and that's gold and silver. With silver, it comes with a VAT charge, VAT, but you factor that into your cost and your potential gain. Now, view gold and silver, I view it as a 2, 3, maybe 5 year trading plan. Some view it as a lifetime plan, and I might do that. It depends if I need the money or want the money at the time. XRP, that's just a cryptocurrency. It's a really good one in my opinion. Here we go. And Basel III. Now, BIS is the big central bank of central banks. Basel III was released back a couple of days ago from memory. That is a new, or stage 3 of the global financial regulatory reform. Now, that has some potential positive impact for gold. And we go here. Now, a recession. Now, this is where we could be heading. A period of temporary economic decline, during which trade and industrial activity are reduced, generally identified by a fall in gross domestic product in 2 successive quarters. Now, GDP is, of course, all the money you spend on sugar, food, petrol, and so on. And America, on my last look about a month or so ago, was debt to GDP was 130, which basically means they're bankrupt. UK had climbed from 84 to 94.5, so it's sort of on its way. That makes economic management for these countries a challenge. But hey, they print money; they're money machines, so I'm sure they'll crack it. What do we have? Here we go. A depression is characterized by the length of abnormal increases in unemployment, falls in the availability of credit, and basically production. So no one's buying anything, no one can borrow anything, there's no jobs, and some people say that we are heading for a depression. Again, I'm not convinced. I do believe, my opinion, that we are heading for a recession, but you know what? We just trade out of these things. So let me stop the screen share. Let's get back to you. There we go. As you can tell, this is I'm in Spain at the moment, so I came out a few days ago to enjoy some sunshine. Incidentally, and this was really a real shocker, off topic slightly, there was no passport control. We all just went straight through, which is madness when you consider the sort of emphasis on everything we are experiencing. Business valuations. When there's no interest in the bank, when inflation climbs, all the money people, whether it's private equity, venture capital, pretty much the same these days, wealthy individuals, super wealthy individuals, they have to make their money work. It's no good leaving it in the bank, because if inflation is 6% or 3%, it basically means your money is going back by that amount if you leave it in the bank, because the banks don't give you that much interest. I think I get 0.1 or 0.2%. So if I left cash in the bank, of course, I'm going backwards by the difference, 2.9 or something %. And as inflation goes up, which means that the value of that pound is vastly reduced. So you have to invest the money and invest it wisely. And gold over time has always climbed. Over 10, 20, 30, 50, 100 years, always climbs, as does property. Sounds like I'm peddling gold. I'm not. I just actually quite like it because it's safe, or feels safe to me, and it's part of the portfolio. Business valuations do go up. There's a scramble for acquisitions in the marketplace. You'll see it in the media. You'll see it in the news, where valuations are what we call going from 3, 4, or 5 times EBITDA, earnings before income tax, depreciation, amortization. It's basically net profit and some add backs. Going to 6, 7, 8, 9, 10, 12, 14 times, because these companies are looking, the investors are looking for good assets. And I will make another video on how to structure your business and develop your business with the right metrics in place, the right management reports, etc., in place, in order to maximize your valuation. Because I have done this in the past, and it's not as easy as you think. But I will make another video on that. It's quite an interesting world. So look, I'm pretty much done. I hope you found that video useful. And I will say, I do this free of charge because I believe it's the right thing to do. please do subscribe. Please do share far and wide as much as you can. And that would really help and actually motivate me. It's why it takes me so long to make more videos. I need the motivation. My motivation isn't the money. My motivation is getting people to subscribe and share, because I like to see, you know, people doing well. Any questions? I'm on Twitter at LyndonX. I'm also available, oh, let me think now, on LinkedIn. There you go, I'm on LinkedIn, Lyndon Wood. You can find me, you know, in numerous places. So please seek me out. You can direct message me. I will do my best to reply to everybody. Thank you very much.